everyone, welcome back to Corporate Decoder. Today, we're diving into a report that might sound like financial mumbo jumbo, but trust me, there are some interesting twists and turns. We're looking at Victory Portfolios IV and some of their fund reports. It's like peeking behind the curtain to see how these investment companies are really doing. This report is really interesting because it outlines a big change. Pioneer funds being rolled into Victory Capital. It's like one big fish swallowing a smaller one, and we need to see who benefits. Remember, this report isn't just about numbers. It's about what those numbers mean for you if you're an investor. Before we get into the weeds, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come join the conversation. We're starting with the Victory Pioneer Fundamental Growth Fund's annual shareholder report. We see here that this report is a successor to the Pioneer Fundamental Growth Fund, so we will want to pay attention to changes. First, let's talk about costs. If you had a Class A share and invested 10 grand, it cost you about $99 in fees. That's almost 1%, which for some might feel like a bit much to pay to the fund managers. How did they do? Well, for the year ending March 31st, 2025, the Class A shares had a return of negative 0.08%. Not exactly setting the world on fire, especially when you see that the S&P 500 total return index did 8.25% over the same period. It looks like they struggled with picking the right stocks, missing out on big gains from companies like Apple and Nvidia. Here's a look at how a $10,000 investment would have grown over the last 10 years compared to the S&P 500 and the Russell 1000 Growth Total Return Index. Peeking at the average annual total return table for Class A shares without sales charges shows an average return over the last 5 years of 17.01% and 12.39% over 10 years. The most recent year, though, was negative, which is not great. There were some big changes with this report, including a reorganization with Pioneer Fundamental Growth Fund and a change in investment advisor with Victory Capital Management Inc. taking the reins, which is pretty typical for a company of this size. We see that the total advisory fee was $45 million. Ouch. Looking at where the money went, almost 39% was dumped into information technology, followed by consumer discretionary and financials. That's tech heavy, which reflects the current market trends. Moving on, let's check out the Victory Pioneer Multi-Asset Ultra Short Income Fund. This fund is a very different beast, so we will be on the lookout for the differences. Class A investors paid around 60 grounds, a 10 grand investment. That is a much smaller fee than the prior fund. How did this fund perform? The Class A shares were up 5.85% for the year, beating the pants off both the Bloomberg US Aggregate Bond Total Return Index at 4.97 M-turn. Seems like this fund's managers made some smart moves in credit positioning and securitized credit allocations. Instead of tech stocks, this fund is all about bonds, corporate bonds, asset-backed securities, those kinds of things. The lack of diversification by sector is concerning though. If the bond market falters, so too will this fund's returns. They have 17,000 in the Federal National Mortgage Association, which has been doing well, so good pick there. On the asset side, we have 7,900, 5,345 of that, and plenty more in similar notes. Here's a peek at how the fund's portfolio breaks down. Digging into where this fund invests, there's a mix, but the key here is debt. It's all about corporate bonds, asset-backed securities, and such. This fund was also subject to reorganization, not great. Just like with the other fund, this one also had a change in advisor going from Amundi to Victory Capital. So what's the story here? On the one hand, Victory Capital Management took over. It's a mixed bag. Now, looking at these results more broadly, Victory Capital seems to be going through a lot of changes, buying up other companies. It looks like they will continue doing what they are and what their style will do. This does open up opportunities for asset growth and economies of scale, but it depends whether they focus on these changes. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Also, don't forget to check out the Discord in the description. Thanks for watching. See you next time.